So, fund management in the modern world. I was given the choice of title. I chose this one. I'm a practitioner, and I've been doing it a while, so I'm going to give you a few facts and an awful lot of opinions, which I make no apology, but you can always challenge me to see whether I'm bluffing or not. So, I thought I'd start with some quotes, which you probably can't see because it's a very big room, because this is an academic sort of event, I thought. So the questions may be the same, but the answers are different. That's Einstein, I agree. Though it took the world by surprise, it was the inevitable outcome of a long period of gestation. Think about Lehman's 8 years ago. Yep. And for every complex problem, there is an answer that is direct, simple, and wrong. If you're a journalist, you're tempted to commentate. If you're a politician, there you go. That's the danger. Right, introductions. You've had a bit of my background. Quilter Cheviot, we manage £19 billion of private clients' money and a few charities. Lot of money for ordinary people, most of whom live in this country, most of them pay their taxes. I've been an investment manager since I came out of Cambridge in 1980, where I studied natural sciences, and that is important. It introduces a certain bias. I've had various jobs. I've tended to move after the companies I've worked for have been taken over. So M&A people, beware. And after 7 years managing businesses, I walked out of the corner office and went back to running money in 2007 at Quilter Cheviot. That's what I do. My biases, I'm an empiricist. I don't really like imaginative theories because I think they're expensive and they don't work. And if I ever sound flippant, I apologize, but it's just because I like to sleep at night. Investing people's savings is a very serious business. It is not a game. People have sweated a lot to get what they've got, and they deserve to be well looked after. And the other thing that really irritates me is that people tend to talk about institutions being smart and private client money being dumb. Well, I think people are very smart. I think they are early adopters, they're sensible, and they're practical. You tell me that institutions aren't dumb when you look about what's happened over the last 10 years. So, 36 years of experience, which seemed like an awfully long time, but I enjoy myself, and so it's gone in an instant. So I should make some comments. Zero or negative interest rates, isn't that an extraordinary thing to think about? That means that every single thing that I do now for my clients, every single investment that we all make now to improve on zero return involves risk. There is no risk-free return anymore. There are no easy solutions. And there's an awful lot of very grey, mushy thinking, which is why returns are so poor, because you actually need conviction to make money. Doesn't mean you have to be right all the time, but you need to make a decision, and then you decide to move on if it needs to be changed. The other thing, which is sort of, I would say, second or even third hand, therefore don't listen to it, is that if someone says it's different this time, you leave the room. Well, I'm going to say it, and please don't go. Things are changing. There is structural change. This is one of those times when it is getting different. Maybe 2016 will be a different period from the last 10 years. But I just don't believe that these are standard times. So what really matters to me as an investment manager, which is part of what I want to talk about, is growth. How do I find growth in a world where it seems to be very hard to come by? The other point I'll just make about investment is there aren't any quick fixes, that patience is a virtue. If you can be patient, the payout is phenomenal. So, since I started, I might as well make it personal to me in 1980. This is the UK equity market. It's multiplied by 17 times. There's 1987, doesn't show very much now. It is interesting that the volatility in the last 15 years has been quite extreme. Therefore, it sort of does matter when you start, and it does mean that you can't really sort of jump in and hold on. But it's a long way up in those periods, and that's a huge period of growth. And I think I just wanted to, I will be touching on active, passive. You need to get yourself attached to the markets to make money. Interest rates. When I started working, interest rates, something called minimum lending rate, was 17%. We all now know where we are now. I rather like this. I just stole this off the internet. But Paul Volcker, who was chairman of the Federal Reserve in the early 80s, was 6'7" when interest rates were absolutely up there. Alan Greenspan was a bit shorter. Ben Bernanke was a bit shorter than I am. And Janet Yellen isn't very tall at all. So if you want to know where rates are going from now, look out and see who gets the job next. But it is extraordinary to think about 0 to negative interest rates. I mean, yeah, well, I won't even dwell on that for much longer, but what a change. What a change. And to think that it's going to be the same in the next 30-odd years as it was in the last 30, when you've had that, I think is probably understating the issues. So what about GDP, economic growth? Again, 1980 to now, and how much of these countries increased their GDP. So the US is the biggest, it's gone up 6 times. Look at little old China going up 38 times. We know these things because it's always in the headlines. A couple of insights. I think it's quite interesting that the UK now is as big as the US was in 1980. We're the 5th biggest economy in the world. Let's not underplay it. And we've gone up 5 times. A bit more history. In 1600, China and India combined, and don't ask me to prove this one, Jeanette, were about 50% of global GDP. By 1980, they were 4%, and now they're 18%. Times are changing. Another bit of information. What about the largest companies? When I started work, 5 of the top 10 companies in the world didn't even exist. In fact, if I'd written 1990, it would have been the same. This idea that somehow there's a blue chip that you can invest in that gives you a return, you don't need to bother about innovation, is all nonsense. Look at this. None of those companies that now dominate global economy were around, or the ones in blue, the yeses. And what about the rest of the world? Shows the US is important, by the way. China's got 10 in the top 100. We've got 5. Germany's got 4. The Japanese have got 3. All right, so the US is still where it seems to matter, where things seem to be happening, which is quite extraordinary. Now, I'm just painting a picture of what I think is the world we live in to talk about why fund management in the modern world is a challenge, but a fascinating challenge. So this is another way of looking at the US economy. These are the countries which you won't see at the back, superimposed on the states of the US with the same economic or GDP. You know, so Brazil is the same as California. You know, so there's any Americans here? Anyway, there's Greece and there's Connecticut. You think how much time was spent arguing and the toss about what's going on in Greece over the last few years? Have you ever heard about what's going on in Connecticut? You haven't. US GDP is very domestic. 70% is domestic. They're not a big exporter like us. What happens in America is that they spend the money. They make it and spend it. It's 17% of global GDP is made up of US consumers. I was sort of talking to someone who wanted to sell me the idea of investing in films, an American, and it wasn't a dodgy tax scheme, it was proper investment in films. And I was listening to him quite politely, and I said, listen, what I don't get is why anyone finds Adam Sandler comedies funny. You know, I thought that was a very smart English sort of thing to say to an American. And he said, you know, David, I agree with you, but there are 250 million people who live between here and here who don't. And that's the key point. What are these people up to? What are they spending their money on? What do they want? Defines success or failure if you're a company. And my job as an investment manager, says he very grandly, is to go and find those companies that are delivering what the people are looking for. So active, passive, and advice gap. And I'm just sort of painting, again, a bit like, well, just touching on things that I think matter in investment management. An opinion. I think the gap between the winners and losers over the next 10 years will be as extreme as the 1970s. In 1970, if you retired with a pension, which would give you a good standard of living, and it wasn't index linked in those days, and you did nothing about it, you were poor by 1980. I came into the investment world seeing the damage done to people who had solid careers and pensions that were destroyed by inflation. It'll be different this time, but I still think that the winners and losers there'll be a big gap between them. I think globalization, I think technology is driving change and will define winners and losers. I think investing in indices is potentially more risky and more volatile than actively managed diversified portfolios, which I'll come back onto now. But you just have to look at the composition of European bond indices. You have to look at what the ECB is actually buying. You know, they can't buy bonds from the German government because the yields are too low, so they're filling up with lots of Italian stuff. You know, it's that sort of problem. That's what the indices now offer us. So if you want to attach yourself to an index as opposed to attach yourself to common sense, then good luck. The other thing that's really been done by stealth over the last 20-odd years is that governments and companies have transferred the responsibility for financial security individually in this room from themselves to us. They didn't really say it that way, but you think about it. Final salary pension schemes, state pensions, all the things that we sort of used to think were there for us have gradually disappeared, to the extent that we now also have zero interest rate for money on deposit. There's deposit protection, jolly good, but people don't want zero, so they're investing in investments. And you know what? If you invest in investments and those investments get in trouble, nobody comes and bails you out. You lose money. That's what investment's all about. So gradually, we've all taken on responsibility for ourselves. Therefore, we better get it right, or we better take good advice. And my opinion, and I would say that, wouldn't I, is that good advice is worth paying for. Return and risk, this is the same theme. In 1995, you could invest 100% of your money in US government bonds and get an estimated expected return of 7.5% with a volatility, let's call it volatility of 6. Dead easy. Anyone could do that. You don't need advice for that. You can buy a passive index tracker. Fast forward 10 years, it's beginning to look a bit more complicated. Now in 2015, to get that 7.5% return, you have to have a diversified portfolio of bonds, equities, international diversification, property, and private equity. I just lifted this out of the Wall Street Journal. I thought it was great. The volatility is 3 times what it was. Oh dear. You know, it's not going to be easy. And you think of trying to do that without any sort of knowledge of financial markets, I think it's next to impossible. So, a few other matters. I touched on the US, the developed world, and there's a lot of talk about, oh, surely we should be investing in the emerging economies. They're the place to be, surely, surely. I do believe the power of 7 billion people is extremely important. It does define us. I think the internet has enfranchised these 7 billion people, and that's continuing as we speak. But we've got technology, we've got automation, robotics, we've got the fact that Adidas is now making trainers in Germany for the first time in 30 years. They're doing it because they can do it cheaper than making them in Vietnam or China and shipping them back across the world. I think that's extraordinary. It's only going to carry on that way. You know, the closer you are to your consumer, the cheaper it is, as long as you don't have to pay huge amounts to other people, to the employees to make them. The opportunities are endless, but it means that if I'm investing in a developed economy equity or an emerging economy equity, it's because they're a good company. It doesn't really matter so much where they are. They have no right to be the best investment just because they're sitting in India or China or somewhere. Absolute versus relative. In my time, institutions are becoming more like private clients. Everybody wants absolute return now. Relative to an index is becoming much less interesting. The other point I'd make is that quite often one thinks that people don't want volatility, so they should be offered protection against that volatility, a sort of security blanket. The problem is that the cost of the security blanket is roughly half the expected return. That's the most expensive insurance policy I can think of. If you really want to be comfortable that every day of the week you're happy with how much money you've got, it's going to cost you in terms of return. Far better to take a step back. The other thing is that long only and hedge funds are converging both in terms of strategies and fees. It's just going to go further on. I think the 2 and 20 model is under significant threat because the hedge funds haven't been able to deliver the consistency required. They've basically failed to make it on the up markets, and they haven't really protected on the down. So watch this space. And the other thing is again, to my area, the private clients, is that the institutional salesmen that could create products think that private clients want liquidity. They want instant access to their money. No, they don't. They simply want the truth. They want to know that if they are locked in, they've been told they're locked in before they get involved. The problems come when you say you can have instant access and then you invest in something that can't be sold. The latest version of that is property. Probably a minor sort of issue for the moment, but it's to say it follows on. It's happened before, it'll happen again. And private individuals are simply looking to create a long-term return, mostly, and therefore they are prepared to accept illiquidity if they get a better return. It seems to be difficult. So, some final thoughts. I was there in 76, 77, when the punk rock people blew into town. I wasn't one of them, I hasten to add, but I do remember how exciting it was. And if you think that you feel uncomfortable at the moment about politics, the economies, markets, because of their mystifying movements, then don't worry, because I think not all of us feel the same. They are a bit odd at the moment, and we are in a period of structural change. And all you have to remember is that back in the mid-70s there was a thing called progressive rock, and the music industry loved it to bits, and Pink Floyd and Tubular Bells and all those people were very well respected and very pompous, and then this lot blew into town and destroyed the whole thing in a matter of a couple of years. And that can happen. Change happens, it happens very quickly. It took a long time for the music industry to catch up with it. So, to finish, I put here fund managers, and this is the joy of the job, inhabit the unknowable future, but the great thing now is that we are citizens of the world, because nobody can stop us going out there to find good investments wherever they happen to be. This is not the 1970s when we had exchange controls. We have opportunity. So that's why I've been giving you a tour around all these different bits of information about what I think is happening in the world around us and some pointers to the future. Thank you.